Yes.
You're unmuted, we're good.
Okay. Good afternoon, everybody, and welcome to the investment meeting for September 2023. Please make your introductions to the record.
Stephanie Ginsburg, representing Police Commissioner Caban.
Allison Hirsch, representing Controller Revenue.
John Dorso, alternate designee.
And head of the Bureau of Asset Management is an invited participant.
Brian Birdie, representing Mayor Eric Adams. Kevin Mayer for Finance Commissioner and Neglect.
Arthur Eggman for the PBA.
Chris McGrath, PBA by invitation.
Albert Acerno, PBA.
Rob Appling, Wilshire by invitation of the trustees.
Nicole Jambrisi, Police Pension Fund, present by invitation of the fund.
Ed Berman, also control by invitation.
Jeffrey Ward, DEA.
Johnny Ramirez of the CEA.
We'll just finish around the room, and then I'll get to the people that are.
Andy Miller, Police Pension Fund, present by invitation.
Bob Sanskistad, Pension Fund, present by invitation.
Kevin Holleran, Pension Fund, present by invitation, and LBA.
Chris Cantelmi from the LBA.
Okay, Law Department, are they on, Nicole?
I don't believe they're participating.
All right, and with that,
Actually.
Mark Tuskevich, Office of the Actuary by invitation.
great, thank you. And with that, I'll turn it over to John for the introduction of BAM as necessary.
Yes, so I will note that there are several members of the BAM team that are joining on Zoom for the public session. In the event that any of those members participate in the meeting, we will ask that they identify themselves before we move forward. So with that said, if it pleases the board, we'd like to begin the agenda. We have 3 items that are very quick in public session. The first of which is the longest portion of that, and probably more important, and that is the quarterly presentation. So we're going to turn it over to Steve Meyer to walk us through the quarterly presentation at a brisk pace, and then we have a risk update as well. So Steve, we'll turn it over to you.
Thank you, John. And in the interest of brevity, I'm going to try to cut my remarks in half. Just going to and ask. Doesn't mean that you can't ask questions, and if there are questions you want to ask afterwards, myself and Ed are available to answer those. So first slide, really, maybe to set up, so when I give these quarterly updates, usually month to month, we give an update really just in terms of what's going on in the portfolio. It's a very short time frame, it's a 2-minute update. Quarterly updates are meant to be a little more in-depth. So what I typically try to do is make you aware of what's going on in the economy, how that relates to what's going on in asset prices in the markets, and ultimately, most importantly, how that impacts your portfolio. So on slide 1, Wilfredo, just a quick look at what's going on in the economy. Obviously, inflation has been the hot topic for the last 15, 18 months. We still have relatively high inflation here in the States. The Fed has not necessarily done hiking rates yet, but they are very close to the end. Perhaps one more cut, I would imagine, in November. But again, that's going to be data dependent. The economy's inflation rather has come down nicely as well. They'll probably see hikes again from the ECB and the Bank of England, but again, they're closer to the end than they are at the beginning of their hiking cycle. And lastly, China is experiencing some level of disinflation, which means a reduction in the rate of inflation or outright deflation, where asset prices are going down. So they're kind of out of sync with the rest of the world. On the next slide, a look at U.S. Headline CPI. Unfortunately, more importantly, the core CPI. Thank you very much. So this is from the July numbers. You can see CPI has moved down from a peak in June of 2022 of 9.1%. It's just 3.18% at the last reporting. Core inflation, however, excluding energy, is still above 4%, a little stickier. So that's the Fed continues to focus on that core PC deflator and trying to get that number down. The next slide is a different look at something called superinflation, with core how you see it's still hovering between 4 and 5%. That's what's going to keep the Fed on its hiking cycle to the extent they continue. They do want to see that level come down as well to closer to 2%. And the next slide, just a look at where inflation is around the world. In the red, you can see the U.S., again, coming off of its peak, is in pretty good shape, moving down in headline CPI. Europe in blue, and the UK in the light gray. There's still some work to be done there, again, which is why I think they'll continue to hike rates in the coming months and quarters. U.S. employment. U.S. employment is still slowing, but it's still solid relative to where we are from a monetary policy standpoint. and relative to, or in terms of expectations for a slowing economy. Average job creation for the past 3 months, again, adjusted for revisions, is a little over 150,000, which is pretty robust and more than replaces the number of job entrants coming into the market. Unemployment, however, to 3%, which was reported last. I think that's a good sign for the Fed, although 100% of that increase in unemployment was due to new people entering the labor market and the participation rate going higher. To that extent, on the next slide, you can see the participation rate, which is in yellow. It's still below where it was pre-COVID, but moving up nicely. Again, the August print was actually 62.8%, and as I mentioned earlier, unemployment actually moved up to 3.8%, that lower white bar. So again, the labor market is still relatively tight, but there are some movements in the right direction in terms of lower employment increases, higher unemployment, and an increase in participation rate. On the next slide, very briefly, economic growth. The U.S. economy actually is quite strong. Ed and I were having a debate earlier, but I think there's a Fed outlook that from the Atlanta Fed that is looking for over 5% economic growth in the third quarter, at least. Is actually moving slightly higher from a growth perspective, and China continues to disappoint relative to expectations, although they do have growth rates that are higher than the U.S. and Europe. On the next chart, take a look at the 10-year chart. There's a couple of things when I look at this. I look at the significant disruption to economic growth associated with the pandemic, both the trough down and then the spike higher and the normalization. And when I look at this, I still think that we're pretty far along in the process of repair, but we're not done quite yet. And you can see here that you still have in red U.S. growth around 2 to 3%, again, trending higher more recently. Europe and Japan are performing. And I mentioned China disappointing relative to expectations, but the growth rates are still 4 to 5%. On the next slide, interest rate hikes are nearing the end, both here and in Europe. China has been cutting rates to stimulate growth in that economy. And Japan is still very accommodative with a negative real interest rate of its official rate. On the next slide, just to look at the performance we've seen and the rate hiking cycle we've experienced, again, since the early part of 2022. You can see those staircases on the far right-hand side of the chart. On the top, you can see U.S. Fed funds with an upper limit of 5.5% today. The Bank of England's official rate, 5.25%. The ECB, the European Central Bank, is 3.75%. And again, the laggard here, the outlier here, is Japan, with continuing with yield curve control, which they've loosened up a little bit. But there still are negative official rates, negative 10 basis points in Japan. So still a little bit of an outlier and probably changes to come. On the next slide, a quick look at where we are in terms of yields and credit spreads. U.S. Treasury yields have moved pretty significantly higher than some we've experienced, a decent amount of volatility. Investment grade and high yield credit spreads, they've all tightened, and they're not pricing in a recession in the offing in the coming months and quarters. We're still hoping for a soft landing. I know the Fed's hoping for a soft landing, but I do think there's some evidence and some indicators out there that reflect that we still may see a recession over the coming 2 quarters. Next slide, look at those yield spreads. You can see on the upper bar, that right-hand chart, that's as of August 22nd. The one right below that in orange is of the end of the fiscal year, June 30th. You can see this is a pretty dramatic move up in short, but more importantly, intermediate and long-term yields. Again, pricing in inflation that continues to be a little resilient, again, with that core between 4 and 5%, and the economy continue to be relatively strong, and the Fed reflects higher for longer. We also still have an inverted yield curve, although the inversion at this point is only about 70 basis points. That indicates that the market's pricing in a reduction in official rates and the potential for a recession. On the next slide, a look at that inversion. So typically you look at the 2-year Treasury spreads, actually one slide before, Wilfredo. The 2-year Treasury yields relative to the 10-year. In green, that's the 10-year below the short-term rate 2s. Actually, more recently, the 10 years have been at 4.24, and the 2 years at 4.94. So 70 basis point inversion still believe at one point it was as wide as 120 basis points. So some movements there. On the next slide, I mentioned credit spreads are tight. They're actually very tight relative to, again, where we are in the hiking cycle and relative to the potential for a recession in the coming months and quarters. High yield spreads are at about 370 today. You can see in yellow there, as of the time we cut this print, it was in 380. Investment grade spreads at 115 basis points. And that's basically a fancy way of saying if I were to buy a similar maturity treasury, I would add 370 basis points on top of it, and that's what I would be paid for that additional default risk of owning a high yield corporate bond. And that also represents an income potential for the fund. On the next slide, as a general matter, more recently we've seen stocks have been very strong this year, and bonds have been both volatile and generally weaker this summer. On the next slide, you can see evidence of that in terms of the second quarter returns, sort of in the middle of the page there. You can see equities, again, the Russell 3000 up almost 8.4% for the third quarter. For the second quarter. Developed market ex-US a little under 3%. Markets less than 1%. I'd say more dramatic here is the continued challenges we've seen in the bond market with yields higher. Long duration bonds down 2.3% for the second quarter. U.S. government or custom benchmark down almost 2%, and investment grade corporates still underperforming. High yield, however, has developed a positive return, delivered a positive return for two reasons. Typically, the yields in those bonds are higher, and the duration, because of those higher yields, is probably around half of what it is for the investment grade index. On the next slide, a quick look at equity markets. There's actually a little bit of confusion on this side. It looks like there's a lot to look at, but let's take the first line. You can see the Dow Jones Industrial Average year to date has delivered a 4.4% return. Below that, the S&P 500, 15.3%. And more dramatically, I guess, is the NASDAQ returning almost 31%. Again, under EMEA, European, Middle Asia and Asian markets. So here we're going to look at the yield returns on the market. So the Euro Stock Index is up 13% year to date. More importantly, because the dollar's weakened a little bit, in local currency terms, when it's converted back to dollars, it's delivered a 14% return. And you can look down and see that the equity markets have been fairly strong. The Nikkei in Japan is up 23% in local terms, but because the Japanese yen has weakened significantly relative to the U.S. dollar, it's only delivered a 10% actual return when converted back to dollars. On the next slide, a quick look at world bond markets. U.S. 10-year yields are higher, which means bond prices are lower. It's a little bit more mixed in Europe. On the far right-hand side, I'm looking at the change in yield spreads year to date. And at the bottom of the chart, you can see in Asia. So the Japanese yields, the 10-year yields are up about 25 basis points. Australia up 9 basis points. New Zealand bond yields moving higher, 56 basis points. That just indicates that those bond markets are sluggish. The outlier in Asia, however, is China. You can see that the 10-year sovereign yields there moved down about 25 basis points. Again, given the weakness in the economy and expectations for inflation to be lower. On the next slide, just a quick look at those market returns again. On the left-hand side, the far right-hand side of the left-hand chart, you can see the recovery of equity prices over the last 12 months. And that's actually a chart that goes over 20 years. On the right-hand side, you can see the Bloomberg aggregate annualized returns and the dramatic year we had in 2022 on the drawdown of almost 15%. The nice recovery we saw in the latter part of in terms of yields moving up and bond prices moving down. Some recent headlines, I don't know if you've heard, but Fitch actually downgraded U.S. sovereign debt from AAA to AA+. There's some questions about the timing of that, but I think that is just an evidence of concern on the part of the credit rating agencies around our ability to handle our national debt, and potentially some concern just about the level of deficits that we're generating. It's, say, $2 trillion this year alone. The other area that's been in the news pretty heavily is artificial intelligence. And I personally believe it's going to have a significant positive impact on productivity in our economy. But there is some concern about some of the stocks reaching speculative levels. NVIDIA has been named recently. They're a chip maker that specializes in artificial intelligence. So to watch and be aware of. A couple slides to follow, some food for thought. So earlier this year, we had the regional bank challenges. And here we can see evidence in 2023, it's really limited the ability and the willingness of banks to lend money. So the loan growth rate, that red chart on the bottom, relative to the prior year is significantly lower. So there's not a lot of loans being made by banks at this point relative to the previous year. And why that's important, on the next page, if you look at the financing sources for small businesses, it's dominated by banks. Almost 70% of small business financing comes from banks. And again, if there's a reluctancy or inability or an unwillingness for banks to lend money, it's going to hurt a significant portion of our economy. On the next slide, you can look at the size of the companies in the U.S. The light far right hand side, those have less than 500 employees, small to medium-sized businesses. Again, it's almost half the economy. So if there's a pullback in credit creation, credit extension from banks to these institutions, it has the impact of slowing economic growth over time. Maybe another slide, the next slide looks at evidence of that. So you've heard me in the past talk about the Fed's rate hiking cycle. We've seen a significant increase in short rates with the idea of slowing the economy to dampen inflation. And those rate hikes tend to work with a significant lagged impact, which means it takes time for them to work their way through the economy. However, with the tightening of credit conditions, again, some of that resulting from the pullback in the willingness and ability for banks to lend, particularly regional banks, it actually will focus and reduce growth that much faster. We're not seeing evidence of that right now. Again, I had statements earlier about GDP growth for July and August, pretty robust. Again, if GDP comes in at anywhere between 4 or 5, even as high as 6%, that's a significant outcome. And that's why the Fed's going to be higher for longer and be patient as these rate hikes work their way through the economy, and perhaps be more inclined to raise rates again. On the next slide, just again, it's more food for thought. This is what the Fed's trying to avoid. This is actually a little confusing slide, but it's an interesting slide in terms of looking back to the 1970s and 1980s to two peak inflation cycles in dark blue. And in green, you can see where we are relative to today. This is what the Fed wants to avoid. They want to make sure that they don't cut rates or stop their tightening cycle too soon and have another leg up in inflation like we experienced with the two oil price shocks in our economy and inflation in the 1970s and early 80s. On the next slide, bond default rates are actually moving. The spreads and investment grade public market credit spreads, although default rates are moving higher. So my expectation is you'll see credit spreads at some point widen and be a better opportunity to allocate money into in coming quarters. Let me skip the next two slides. So when we get to performance on slide 30, Wilfredo, one more, please. Here, I'd say the most important thing you want to look at is the police total plan return, including public and private assets on the top line. For the second quarter of this calendar year, the fourth quarter of the fiscal year 2023, we delivered a 2.9% return. More importantly, the one-year fiscal year 2023 returns were 8.1%, which is a good outcome. But perhaps more importantly, we've actually exceeded the 7% targeted return over 5 years, which, again, investing in assets in a public plan like this, you want to really think long-term. 5 years is still probably too short. You probably want to focus more on 7 to 10 year returns over time. But again, the outperformance relative to that hurdle rate of 7% is still encouraging. On the next slide, I'll look at your net public market returns by strategy. Again, here we see evidence again for the second quarter of 2023, outperformance in equities, U.S. equities, world ex-U.S. and emerging markets, again, 7.1%, 3.3% and 3.1% respectively. Some more challenges in core fixed income and TIPS, which tend to be a little higher duration. High yields outperform because of its low duration and higher coupons. Convertible bonds have outperformed because they tend to be more of a proxy for equities, and say about the ETI, mortgage related, have been a little more challenging with the backup and short rates. And lastly, cash is king. Cash continues to deliver positive returns consistently, and cash rates right now in, say, the overnight space are around 5.3%. So when you have any cash in your portfolio and invest in short assets, it's delivering some level of return versus just being pure cash drag. On the next slide, look at the excess returns by strategies for your plan. You can see that we actually underperformed the Russell 3000 index with active exposure in the first 3 months the second quarter of the year for 3 months by 124 basis points. However, we outperformed in non-US and emerging markets. Core fixed income, we've actually outperformed relative to that structured index. But again, it's been a little more challenging in the fixed income space in terms of TIPS, high yield, convertible, conservative. So when equities outperform, we tend to underperform, and that's evidenced by 198 basis points, 1.98% underperformance relative to that benchmark for converts. Again, bottom line, you can see that the police fund relative to its policy benchmark underperformed on 75 basis points for the second quarter. And that's due to a couple of things. So right now, we're technically overweight private equity and core real estate. Both of those assets have a little bit of a drawdown or reduction in valuations and pricing this year, and certainly for the quarter. We are also underweight infrastructure, hedge funds, and opportunistic fixed income, all which outperformed the benchmark. So a little bit of a drag there, but again, that will speak to over time. On the next slide, we'll look at the net private returns. Early, you can see that there's been a little bit of stress in terms of the performance in the one-year space for private equity, core real estate, and non-core. Infrastructure, again, for the years outperformed at 8.4%, opportunistic fixed income, 6.4%. But more importantly, if you look to the right, you look at 3-year, 5-year, 10-year, and since inception returns, all positive and significantly so. So private equity had a 23% and a 23.5% return on average over the last 3 years. It gave a little bit of that back in 2022 and early 2023. But again, we're still very constructive on the asset class and believe it will be a strong performer over time. On the next slide, a look at our excess returns in the private market space. The one outlier here in the one-year area, again, is opportunistic fixed income. Although we think those assets continue to perform very well relative to the markets, and relative to tightening, particularly high yield spreads coming, we've underperformed that public market benchmark. That's a combination of high yield and leveraged loans. But again, if you look out again, 3, 5, 10, and since inception, the positive excess returns are very significant. And the last slide before I turn it over to Ed to kind of take us through his risk review is just a look at the rebalancing on the there we go. And you can see here, as equities have outperformed, we've actually sold some of the equities and reallocated in the fixed income because we're trying to keep them in line with the strategic targets. A big part of what we do is we manage cash for your system. We want to make sure we can have the cash on hand and meet benefit payments, as well as capital calls for private assets. And you can see that on the far upper right-hand side, where the cash raised was $655 million for payouts and contributions for capital calls, and the rest is normal course rebalancing. Anything?
How'd you do that without taking a sip of water?
My cup's empty.
So Steve, I just had one small question. The private equity short-term underperformance, does that reflect a lag in the marking of those assets?
Somewhat,
Like,
yeah.
is it sort of relative basically to a past period where the economy as a whole is underperforming more than it is presently?
Yeah, Brad, so those mark-to-markets for private equity were March to March in the one-year space, so there's a little bit of a lag in reporting. We also have seen, equity prices come down that much more in the public space the prior year.
Yeah.
So again, it's just really catching up. I actually think it's healthy that we're really thinking more about, valuations in the private space. I actually think it's still gonna be a very compelling asset class for us to invest in. I know that Rob and Wilshire probably have opinions on private equity. For holding, we think it'll deliver strong returns over time. A little bit of a pullback right now, but like I said, I think that's healthy.
And just to remind, like, the newer folks around the table, or the returning participants around the table, it's not uncommon in the alternative space to have a lag on the returns, because there's usually an independent advisor going in, helping to do the valuations too, so that takes time. So that's why you're always gonna see, on those things, they're never gonna be matching up with the public markets. So just wanted to give you that background piece that I think just to be clear on the record why. That's not a function of the size of the city, it's not the function of the way we do business, it's a function of the industry and how long it takes to get those things done. So I just wanted to put that out there.
So maybe if I can make one other comment, we are actively working on improving our performance reporting. I don't love the slides, I don't need you to follow as much value. So I'm working with the risk team under Ed. We've got Dan Haas, who's kind of stepped up to take a role where he's hybrid between risk and analytics as well as reporting. And I do think that we can do a much better job in terms of representing to you as the trustees of how we're performing and why. I don't know that these slides that we currently use convey all that much information other than raw numbers. So we're trying to think how we can be better presenters of where you are on the performance and really focus on that.
And see if I can piggyback on that. That's the importance of the STAR committee that's been assembled to look at the operations of BAM, the interaction between BAM and the consultants, the interaction between the consultants and the trustees, the controls office and the trustees, and kind of taking all three of those parts and matching them up and trying to produce a better product. Because at the end of the day, as a board, we maximize consultants, we should maximize what we're getting out of the Bureau of Asset Management, we should maximize what we're getting out of our relationships, and if it means enhanced reporting at the end of the day, that would be something that hopefully STAR will help guide. At the end of the day, just to remind folks, STAR is not a one-size-fits-all. There will be things that'll be a suite of things, hopefully, that will produce that would be beneficial to all 5 funds, but it will definitely be an a la carte as far as what you would need to implement the things out of that study that are beneficial to you. We would come with a recommendation, and not just the controls office. We have an outside consultant that is working on that project. They will come with a suite of enhancements and things that would work. I'm not to know what they're going to do, but I would expect that it would be working within what we have today, or probably a version of that if we were to expand into something else, either be reporting or an asset class or something, how we would accommodate that. So I think you're going to see all of that, and I think that that's the piece that the STAR thing is really the importance of the STAR piece. And I know Joe is formally representing this board on that committee, so that's just kind of my way of reminding you guys collectively that police should have somebody from the uniformed services on that committee participating, helping to steer that. So all of that is really to get to the point of it's important enough that somebody from the uniformed services should be on that committee to help participate. So that's
Alejandro was on that committee?
Yes, he was. So that's why I'm hijacking Steve's presentation to make that pitch. So
that's important work too. So we're here to service and support, the trustees of the police department. Right? You guys have a very challenging job where you're all police officers, have the pension, your participants and beneficiaries. It's a lot of responsibility. It's our job of working with your general consultants and your specialty consultants. Are we doing that well? Are we giving you the information? Do these presentations make sense? Are they in a format you like? Are they long enough? Are they short enough? Are there other things you'd like to see? The idea around the STAR review, and Allison, correct me if I'm wrong, it's not to reimpose the SIM. We actually like the unique aspect of each of the funds. We're respectful of the need to customize and try to be more efficient in that. It's really how can we be better partners and service providers in terms of helping you make your decisions. So I appreciated Kevin's comments. You're right. The Bureau of Asset Management, everyone works really hard on these things, and I appreciate the fact that you take that for granted. But I want to make sure that we're hitting the marks, that you're getting what you need from us, because you have important work. You know, we make recommendations. Rob, we make recommendations. You guys make decisions.
Piggy on the agenda a little bit later that I feel like probably makes sense to just touch
Oh,
on
I'm sorry. Am I
right
feeling
now.
I'm sorry.
No, John Dorsett did it. That I think makes sense to just highlight now. There's something on the agenda later about BAM University. Everybody should have a calendar invite for Friday, September 22nd and Friday.
Allison, just folks online can't hear anything.
That after a month, he's like, I had no idea what the BAM staff did. And so the idea of the BAM University, for lack of a better name, is to have 2 days where we sort of go through sort of area by area what the team, the staff does at Bureau of Asset Management, what the process is for a public market manager recommendation from inception to green light committee to investment committee to board approval, and then what happens once we've made an investment, how do we track those things, et cetera. And then on the first day will be focused on the public markets, the second day will be focused on private, since those are two different processes. So the idea is to sort of get rid of the curtain, right, so that everybody actually understands what the team does on behalf of the trustees. And then on the second day, we've invited, McKinsey is the consultant that is going to be doing the STAR report, that they were selected after, screening process, an interview process that Joe actually participated in before he left as one of the trustees on the committee. They are going to be sitting in on the 2 days of that training so that they also see how we do things now and can tell us how we're doing them wrong. And then on the second day, the hope is that all the BAM staff will leave, and McKinsey, after we do the presentations, and McKinsey will spend a working lunch with just the trustees to get feedback and insight from all of the trustees in a room together on what we feel like as trustees is working, is not working, et cetera, so that as they begin the review, they're beginning it with a sense of like what trustees actually want, care about, and need. So since that's later on the agenda, I figured I'd just.
We also have a good speaker on the first day at the lunch. We've got Sharmeen Ramani from Goldman Sachs, is the Chief Investment Officer at Wealth Management. She's one of my favorite presenters, and you can go as deep as you need her to go on all asset classes. But she's wonderful, and she's going to be there in person to actually meet with the trustees and present what she does, how she thinks about asset classes, and answer questions. So on the agenda as well for the 22nd.
Can you hear us?
We can hear you now. It cut out for a little while Allison was speaking, but you're back.
Okay.
You didn't need to hear anything.
Did it cut out when John Dorsey was? No.
They hope.
Probably muted it, and then forgot to unmute.
Programmed in.
So that's, thank you actually handling that part of the agenda. So, we're halfway through Steve's part, and, we're done with things. So now we have 1.5 parts of the public left. That's pretty good. So without postponing this any longer, we have the risk update. So we're going to turn it over to Ed to kind of walk us through the risk slides.
Thank you, John. So we just listened to Steve's presentation, and my main takeaway from this is the world is in transition. A lot of things happening. There's a lot of volatility in the market. There's uncertainty about the direction of inflation, interest rates. The world is always uncertain, but even more so. And here we are, kind of managing your portfolio which brings together almost $50 billion, 13 asset classes, 82 public managers, 377 private funds. So there are thousands of people making decisions, touching the portfolio. The markets, there's politics, geopolitics. So all of it presents risk. And the question that always pops in my mind is actually two questions. First of all, is everything in your portfolio functioning as you expect? Are there any surprises? And secondly, will it continue going forward? And that's basically what I'll try to address today in a shortened version, which will take about 15 minutes. And please, I'll move fast. If any questions, stop me or definitely it. So upward. Can we have the next first page, please? Thank you. So all these moving parts, all this uncertainty, we distilled a single number, which is total risk level. You can see this number at the bottom right corner of the page, it's 12.1%. So just to remind you, when we say risk, we measure risk in terms of performance. So 12.1% actually means that we project the next 12 months performance for the system to be within 12.1%, and there's a 15% chance to outperform and 15% chance to underperform. It's all about probability. And then it brings two questions. First of all, is 12.1, is it a good number? It's also a concern. You can see that the risk declined by 0.8% for the quarter. Is it moving in the right direction? So much like in the previous quarters, we're going to steep the onion. We start, first of all, with the market. So you can see it in the column 1 of the table. The market portfolio is just a blend of 65% MSCI equity and 35% of Bloomberg Global Ag, which is bonds and equity blend. And you can see that the total risk for this market portfolio is 11.7%, meaning we expect an 11.7% return over the next 12 months. This is market, this is our baseline. This is here nothing to do with your portfolio application. You also see that the risk for this portfolio, this market portfolio, declined by 70 basis points. And that's again driven purely by the market forces. So for the quarter, the VIX index, which is a measure of equity volatility, declined from 20 to 14, which is historically more in line. And the MOVE index, which is a measure of fixed income volatility, was still elevated, but declined from 122 to about 100. So market is beginning to normalize. Market volatility is coming down. Risks are coming down. So 11.7 is our baseline. The next step in the process is the asset allocation, which is reflected in column 1, which is strategic benchmark. You see the blend of 13 asset classes. And you can see that for this asset allocation, the risks for the portfolio is 11.3. It's actually lower than the market portfolio. And that's a good check on the asset allocation. It's exactly what you want. You want asset allocation to give a better return with low risk. We see it in action. It's 11.3, and you can see it declines in line with the market for 90 basis points. And finally, we're right to your portfolio, which is column 3. Now you can see that this number 12.1 actually makes sense. It's in line with markets. We're running a slightly higher level of risk, and we'll dive more into it in the next pages. But broadly speaking, the main takeaway from this is, first of all, your portfolio is closely aligned with the benchmark as expected. And at the highest level, we do not see any problems within your portfolio. Again, this number 12.1 is still an enormous amount of information.
So, and I just want to make sure I understand that correctly. When you say it's 12.1, is that basically like the absolute value of like one standard deviation of a bell curve? It could go up by 12.1 or down by 12.1?
Well, it's kind of both ways, right? Yeah, you're absolutely right.
Okay.
It's a standard deviation, one standard deviation rule, and that's why this is.
And that's why 30% is the.
Exactly, you're absolutely right.
Okay.
And that's in terms of absolute performance. Of course, we measure performance two ways, absolute and excess returns. That's why we have two measures for risk. Total risk is the absolute return, 12.1%. And an important measure is active risk, which is excess return of the benchmark. You can see it's 2%. And that's what we may expect the portfolio to generate in the excess of the benchmark. And we'll see in the next few pages, most of it is driven by the private markets. And finally, you can see these two charts on the right-hand side of the page. Chart one shows the historical evolution of these three portfolios we just discussed. And you see that this relationship has been very stable. They trend together. That's yet another check that nothing wrong is happening in your portfolio. And active fees, as you can see, is fairly steady. It came down slightly, it's just a reflection of low market volatility. So at the highest level, all is good, but let's dive more into details to see what's happening under the hood. So we have two measures of risk. We'll start with total risk, which is the measure of absolute returns, and then we'll talk about assets. So let's start with total risk. Can we have the next page, please? So what you see on the left is the asset allocation of your portfolio. I'm sure there are no surprises here. Quarter to quarter, maybe a small dip between asset classes, which we just rebalance every week. So we keep your portfolio well within this range. So no surprises here. On the right-hand side, you see what we call risk allocation. And it's really just a breakdown of this 12.1% of risk we just saw. And you'll notice how different this chart is from asset allocation. Right? So even though we know that public equity is 43% of the portfolio, when we talk in terms of risk, it becomes 61%. And risk, again, it's the ability of the portfolio to generate the returns. But also, unfortunately, if something happens in the markets, that's where we're more likely to lose it. Fixed income shrinks materially. Now it's just 8%, so it's not really the area of huge performance driver, which of course was different last year, as we all know. And just for the quarter, again, there were no big changes in the risk allocations. There was a small drift in the developed ex-US. It actually came down slightly by 70 basis points. Some of it is just a function of correlation in the market. Some of it is just our rebalancing process. Nothing noteworthy, which is actually not a bad thing. That's not where you want to see surprises, not on this page. So moving on, as I keep saying, risk is performance. So we need to connect the projected risk with the realized performance. Can we have the next page, please? Thank you. And it's important for two reasons. First of all, it's important as a check on our risk process. So we need to be comfortable that our risk models actually provided a meaningful response. But also, more importantly, it's a check on the asset allocation. So we'll go through asset allocation once every 3 to 5 years, but we've not leave it alone. We're actually watching it actively. And this page shows you the check on the asset allocation. So if you focus on chart one in the upper left corner, the vertical bars show the projected performance for the quarter. The small triangles show the realized performance. What you want to see is the performance to be within the projected range. And occasionally, it will move up and down, and that's the point where we're looking to. So you can see chart number one, clearly everything is within range. You see a small excess return, the total return for the portfolio was 2.9% for the quarter. Most of it is clearly driven by public equities. And I will start just on chart number three, which is the only noteworthy chart here. You see that all three sleeves in the public equity allocation delivered a positive absolute return, all within the range. But it's was a good story for the quarter. And just last point to mention, chart number four, you'll notice cash, which is a very pleasant outlier. It's the only free lunch we have right now. There's no vertical bar. It's almost no risk. Yes, it's a 1.3% return. It's very nice. That's not very usual in this world. But again, it's just a check, no big takeaway. It's good. Moving towards the active risk. So can we have the next page, please? Again, just to remind, active risk is a measure of the excess return that can generate over the benchmark. The active risk in the portfolio is running at 2% this quarter. What you see here is two things. First of all, it's the decomposition of these 2% into asset classes, but also the evolution of this risk over the last 12 months. So what determines the active risk? It's the allocation, but most importantly, it's your managers. To the extent you pick more active managers, you will see more active risk. To the extent your managers take more exposure within their allocations, the activities will go higher. So it's really a check on your managers. And a few things stand out from this chart. So first of all, the allocations have been very steady, so again, nothing really unusual happening. And the thing that jumps at me here is the blue band, private equity, which is not surprising. So with benchmark private equity, we were off of 3,000 plus 300 basis points. We all know that private equity behaves very differently from public markets. There's a lag that Steve just described. And as an investment strategy, private equity operates in a very different fashion. So it's not surprising that private equity produces a strong activity towards public markets. But furthermore, noteworthy are the public markets. And by design, you do not see a significant level of risk. That's what you want. So you can see both public fixed income and public equities have kept relatively level to activities, and that's a reflection of the majority of equities run on passive allocation. So again, it's a good check on what your managers do at the highest level. And much like we spoke, we'll look at the performance. Can we have the next page, please? So here we'll look at the active risk versus excess returns for the managers. It's important for two reasons. First of all, again, it's a check on our risk model. More importantly, it's a check on your managers. So some of your managers take active exposures. The question is, how much? We cannot obviously go manager by manager now, and being in a public session, I will not go and give any names, so we'll keep it anonymous. That said, starting with chart 1, which is the highest level, you can see that your portfolio is delivering a slightly negative excess return, minus 0.7 basis point, just as Steve mentioned before. Almost all of it is driven by public equities. So moving to chart number 3, we see the decomposition of public equities by sleeves. So actually two interesting observations here. First of all, you notice that U.S. equities underperformed, or rather the excess return on U.S. equities exceeded these forecasts, quite material. You can see it's well below this blue bar. And within U.S. equity sleeve, you have 11 main managers plus 7 emerging managers. For this quarter, it was fairly bright dispersion in performance. So we have some managers delivered at plus 2% excess return, some managers delivered minus 5 excess return. It kind of averages out to minus 1%. But the theme, the main driver for that was the stock selection. It's really the process of each manager picking individual stocks. That's what drove the underperformance. I'll come back to this in a second. In the emerging market equity sleeves, you see the opposite, a very strong outperformance. So here you see a plus 2.2% excess return, well above the projected yield. Well above, of course, is good, but we still look into it because it exceeds our forecast. So in the emerging market sleeve, you have 6 major managers and 2 emerging managers. What's interesting is that all 6 managers delivered a positive return in excess of the benchmark with an average excess of 2.2%. It's also interesting that the excess return was given, again, entirely by the stock selection process. Which brings a very interesting question, why it didn't work in the U.S. equities and why it worked in the emerging markets. And it's difficult to give a definite answer, but when we kind of try to analyze it, the structure of the market is very different. So U.S. market, as you heard, I'm sure, many times, is dominated by these big 5 companies, the Googles, the Amazons. So altogether, these 5 companies contribute about 25% of S&P. And these companies outperformed by a broad margin, and Meta performed like through the roof in the second quarter. So for an active manager in the United States, the U.S. market, the active manager needs to make a single decision. The decision is, do I own these big 5 or don't? Almost everything else is not material. The single decision drives excess return in the U.S. market. In the emerging markets, you do not have this dynamic. There's more dispersion. And the average correlation between companies actually declined for the quarter. It's a good environment for active stock pickers. And that's why you see strong outperformance in the emerging markets. In the U.S., it was less so. And of course, we're aware of this phenomena, and the majority of U.S. equity, about 70%, is passive. for exactly this reason. But that's probably one interesting observation for the quarter. So moving ahead, like switching more towards the future markets, so moving forward, much like the previous quarter, we tried to identify the main drivers of the performance going forward in the areas of concern. So again, we kind of split the world into three buckets: equity, trades, and commodities, which represents the main markets globally. And within each of these buckets, we pick three main markets. You can see them on the screen. I'm not going to read them. We use our risk system to project the worst possible monthly return for this market. And you see these numbers here on the screen. We show the last 4 years of historical performance for the market, and you can see these green and red lines up and down. And that's where we project the monthly return may be for the next year. The important thing to keep in mind, the likelihood of the shocks is the same. The numbers are different, but they're equally probable. And one thing that jumps at me is how wide it's ranging up. And it's really a reflection of how unusual the past 4 years have been. So even though the markets begin to normalize, but we're still living within this environment of inflation, pandemic, all this stuff. And I would say for this quarter, so specifically in equities, the shocks came down by about 2%. In commodities, it came down by about 2.5%. But probably the more important chart to keep in mind, and kind of something I'm watching for, is chart number 8 and chart number 9 in the commodities. So oil is the lifeblood of the economy. You can see we put together this chart about a few weeks ago. You see oil at 81. As of last night, the oil is over 90. So it's basically in agreement with Saudi Arabia and Russia cut back on the production capacity. And of course, inflation is not over. Steve had a wonderful chart to show how today's inflation relates to inflation in the 80s. And you can see that our risk system projects that inflation may go equally well to a much higher level or almost a deflation environment. So it really feels like we're in the cusp of a change. It can almost go anyway. So what does this mean for your portfolio? You can see the results on the next page. Thank you. So here again, the way you see the table, we show these 9 main markets, equity, rates, and commodities. You see exactly the same charts as we saw on the previous page. Again, just to remind, these charts are equally likely. They represent the worst monthly move over the next 12 months. And then we show the absolute and the excess return for the portfolio. Starting with column 1, absolute return for the risk-on environment, which is market rally. Starting with equities, you see that by far the largest exposure we have is the U.S. equities. And that's partly by construction, but again, a lot of companies operate on a global scale, especially a lot of American companies operate globally. So just because we allocate to the U.S. stock market doesn't mean actually have exposure purely to the U.S. So it's a good check that your portfolio should perform in the going forward in line with the intended allocation. So by far beyond, your largest exposure is U.S. markets. Emerging markets is your lowest exposure, and that's again, of course, the question of China, which is about 30% of the emerging markets. In the rates, of course, the top of the account is Federal Reserve, which is captured by the 2-year Treasury. This section is the lowest exposure among them all. So your portfolio is not that exposed to the Fed fund rates. Of course, Fed fund rates drive everything. So the second kind of exposure, but your prime concern is the dollar. It's the strength of the dollar, and you can see that for a 10% gain in the dollar exchange rate, your portfolio will gain about 6%. And finally, commodities. It's not something we talk about very often, but commodities have a very strong impact on your portfolio. And in particular, I want to highlight copper. And copper is really one of the most important industrial commodities. Copper goes into manufacturing pretty much everything, and copper is a proxy for the GDP growth. So broadly speaking, a rally in copper, meaning expansion of the global GDP will be net positive for your portfolio. And the last point I want to highlight on this page is the difference between risk on and risk off environment. So, one of the objectives of application is to achieve what we call positive convexity. What I mean by this is your upside is higher than your downside. So you want to make more on the rallies and lose less on the downside. And that's exactly what we see here. So starting with line 1 on the S&P exposure, you see that when it is on, your portfolio gaining 15.8%, and it is off at 15.7%. You may think it's not a big difference, but it's important. It adds up. And you can see that across all asset classes, the portfolio exhibits a positive convexity. Having negative is definitely something for us to look into. And just the last point I want to make, and we have the next page, just looking at the evolution of these stress losses, how it changes. So here we show the last 4 quarters, we do this for a year by now, how this stress loss changes throughout the time, and it has a lot of important information. So probably most interesting here, starting with chart number 1, the exposure to the equity markets, and you can see the exposure is declining. What I mean by this, moving closer to the horizontal axis, meaning you're losing less from the risk-off environment. By far the largest change is the S&P 500. You can see that the stress loss or your exposure to S&P declines. And there's several reasons for it. One of it is just the volatility in the market coming down. So you're less likely to lose money on S&P. Part of it is just changing the stock-bond correlation in the market to feel it more a function of how Federal Reserve is actually managing the economy. But also, it's a reflection of a rally in the market. Actually, the vast majority of the decline is taking place in the fixed income markets. A lot of it coming from high yield, from private pays, or fixed income. And as markets continue rallying and the spread begins to compress, this mismatch is less and less chances for them to move. Right? So I'm not sure if this trend will continue going forward, but for now it's definitely a positive development. In the rates market, chart number 2, you can see it's been very steady for the past year. This is nothing noteworthy. In commodities, chart number 3, you see a broad trend towards lower risk. And it's really just a function of inflation coming down, markets begin to normalize. That's exactly as I would expect it. It's just nice confirmation of function. So I'll stop here and open for any questions.
Any questions? Okay, so I don't see any questions. So I just say the same thing I say, and let Steve start with, you have questions between meetings. The risk team is available, Steve is available. Any of the folks that you see in the room today are always available to you if you have questions, and the people that are zooming in, are there for you. I'll wait for Brian to walk out before I say everybody in the room is here for you. If you want to take a step out.
And Wilshire's available,
And
24/7.
and Wilshire has already stated off the record that they just put on the record they are available 24/7.
You just email us those emails. All right? And your cell phone number.
All right, so with that said, I believe we have one other item in public that is a quick item, and then we'll go into executive. So, Allison, I guess I'll turn it over to you. We've already talked about BAMU, so I think you're prepared for that, and understand the importance of why we think it's great for everybody to show up. So we encourage you. By the way, I'll be calling people on Friday to remind you about it. So, you could talk to me for a long time on Friday, or like 2 seconds on Friday and say, yes, I'm coming. So it's up to you guys. All right.
I'm coming, so you don't even have to.
All right, that's even better.
Just, if you reply yes to the calendar
I did.
invite, you will avoid a call
Yes,
from.
you will avoid a call from
So
there you
just, being judged on.
We'll take care of that today then.
Yeah, exactly. So Allison, you have the last item of the meeting.
Okay, last item on the public agenda. So as you all know, I believe, one of the ways that we, execute our fiduciary responsibility and duty is through our shareholder work and our corporate governance and accountability work. And one of the primary issues that we focus on are labor rights, particularly freedom of association, and making sure that workers are being treated right on the job, and that the companies we invest in on the public side or the private side are not making short-term profit on behalf, on the backs of abusing their workers and at the risk of losing long-term gain, because you're putting aside our, I think, general support of workers' rights and the fact that workers should be treated well. It is not sustainable to abuse your workforce from a fiduciary perspective long-term. And when we do that work, we often do that in coalition. And I think the 5 New York City funds have been seen as leaders in the space around really advocating and pushing for freedom of association, workers' rights in the companies in which we invest. And so we have been asked to join the coordinating committee of a coalition called the Labor Rights Investor Network. The coalition is made up primarily of labor unions and coalitions of labor unions. I think we are currently the only American pension fund that is being asked to join the coordinating committee. The other members are a Uni Global Union, which is basically the international coalition of service workers unions. So like SEIU is a member of Uni Global, UFCW, the equivalent in Australia, England, et cetera. The AFL is a member of the coordinating committee. The SOC Investment Group, which is an organization that we work very closely with. We worked with on the Amazon and Starbucks shareholder proposals that we filed on behalf of police last year. SOC is basically I don't know how many of you know the labor history, but back in the day, the AFL and some of the unions split off and created Change to Win. So SEIU, UFCW, the Teamsters left the AFL, created Change to Win. That was a dismal failure. But what did, and most of them have now rejoined the AFL, but what it did create was a coalition of those unions focused on capital strategies and sort of a corporate approach. The SOC, the Strategic Organizing Center, is the remnants of that and is made up, I think the AFL is now part of it, is a labor coalition around investor action. So I believe we circulated the material background on Convene that gives more information about the network, but we wanted to bring it to each of the boards to actually take an official vote before we put our name on the Labor Rights Investor Network. So that is what I'm going to report to.
And just to be clear on that, putting the name of the fund
Of
rather
the
than.
fund as
rather
opposed to
than
Comptroller Brad
controller.
Lander.
Oh, yeah.
Not
The
surprisingly.
PEA has not seen anything on Convene, in regard to this. I don't even know if I have access to it.
Yeah, you should. If you don't have access to Convene, that's a different problem.
You know, I think I speak on all of our, we're all for labor rights and workers' rights. However, we are not your typical Teamsters / SEIU union, all right? Sometimes these unions work against our own interests of, for example, our topic over the last few years has been what? The fund the police. And a lot of these other labor unions have joined that crusade. So before I think, you know, this is just me talking, before I think I would feel more comfortable doing a little bit deeper dive and making a decision on this in a month or so.
Absolutely.
Before I make any official stance on it today. So I could just do a little more homework and, a little more research on this, network that is coming to us today.
Absolutely, and I'll make sure that we research it.
All right, I would really appreciate it. I don't know if my colleagues in the CEA, LBA, DEA, SBA agree or disagree. I mean, what's your take on it?
Well, with me, you know, we want to, take a look at it. We could even meet ourselves.
Yes, we could meet,
Yeah.
you know, on the side, all right,
So,
during the month.
So I'll just remind everybody, we certainly take a month to do it. We also have the regular meeting next month, so if it's.
Next week.
Sorry, next week. So if in the next 7 days you decide that you want to do something.
Okay.
We're not opposed to just having a vote. If it means taking a month, that's fine too. But I just want to put that out there that, like, you know, we're not wed to doing it at the investment meeting. It's about investments, but at the same time, it's more holistic about our approach to governance. So.
All right.
And I will say, so two things. One is you'll see the it's a very narrowly focused, coalition with a very, tight set of ideas, so it would not be a broader, partnering on other issues.
I also,
Which is,
not to interrupt you, or cut you off, I'm sorry. I did try doing my homework on it this past week. And like, when you go online and you do all like the searches and everything, it's like 15, 20 other whole things come up and not this particular,
yeah, this is
Labor
not
Rights
a
Investment
public
Network.
facing, it's not
Yeah.
a public facing,
so.
coalition, it's a much narrower, so
Yeah.
that doesn't surprise me. So I'll send it to you. And then off the record for a minute?
We're in public, yeah.
Oh, that's fine. If you guys don't have convene access, we should make sure we do a training, because you both have convene accounts.
Okay.
And so we should offline make sure that we can walk you through how to get all the materials.
All right, thank you.
So if that concludes, so that we'll table that item,
Please.
pending next, future meeting. With that said, I'd like to make a motion to exit public session and enter into executive session.
Second.
So whenever you're ready, we're in.
Okay, just, you wanna make sure we clear the room of anybody who.
Yes, yeah, so I just want to, if, Ben could just turn on the camera for the report out. I believe the recording is on.
Okay. No, I think I'm good, thank you. During the executive session, the trustees heard from their consultants, BAM, and several managers regarding the following: real estate and alternative credit. Decisions were made, the results will be made public at the appropriate time.
Thank you. With that, I'd like to make a motion to adjourn.
Second.
Okay, we stand adjourned. Thank you all. Thank you all for zooming in. Thank you. Thank you, actual.